What if the calm tone coming from the Federal Reserve right now is hiding something far more urgent beneath the surface? Because behind closed doors, a $50 billion rescue may already be setting off alarms, shaking confidence, and quietly pointing toward a future where silver no longer trades like an ignored industrial metal, but like a lifeboat everyone suddenly wants at the same time. And once you see how these pieces connect, the price targets people use to laugh at stop sounding crazy and start sounding inevitable. Part 1. To understand why the words Fed panic and bailout are suddenly being whispered in the same sentence, you have to zoom out and look at how fragile the modern financial system really is. Because despite the polished press conferences and carefully chosen language, the system runs on confidence, leverage, and timing, and when one of those cracks, the response is rarely calm or gradual. A $50 billion bailout does not appear out of nowhere. It is not a routine adjustment or a minor liquidity tweak. It is the kind of number that usually shows up when something important breaks, when a large institution or market segment faces losses that could cascade, and when policymakers decide that letting it fail would cause more damage than quietly stepping in. Think of it like a fire department suddenly dispatching multiple trucks in the middle of the night. Officials may tell you everything is under control, but the size of the response tells its own story. The Federal Reserve's job, at least on paper, is to maintain financial stability, control inflation, and support maximum employment. In practice, that often means acting as the lender of last resort when markets freeze. Over the past few years, the Fed has raised interest rates aggressively to fight inflation, pushing borrowing costs to levels not seen in decades. That policy shift has consequences. Bonds issued when rates were near zero lose value as rates rise, and institutions holding large portfolios of those bonds can find themselves sitting on massive, unrealized losses. Banks, funds, and even pension systems suddenly look healthy on the surface but fragile underneath, because if they are forced to sell those assets, the losses become real. This is where panic begins to creep in, not among everyday savers, but inside balance sheets and risk committees. Now imagine a scenario where stress in one corner of the system starts spreading. A large financial player struggles to meet obligations. Liquidity dries up. Counterparties hesitate. The Fed sees the early warning signs and moves quickly, not with words but with money. A $50 billion bailout, whether labeled as an emergency lending facility, a backstop, or a temporary liquidity program, is designed to stop fear from becoming contagious. But here is the key point many people miss. Bailouts do not fix underlying problems. They buy time. They delay recognition of losses. They keep the machine running a little longer. And every time this happens, the message to markets is subtle but powerful. When stress appears, more money will be created, more liquidity will be injected, and the currency itself will quietly absorb the shock. This is where precious metals enter the conversation, especially silver. Unlike stocks or bonds, silver is not a promise to pay. It is not dependent on earnings forecasts or central bank. Credibility. It is a physical asset with industrial uses and monetary history, and that combination gives it a unique role during periods of financial stress. Historically, when central banks respond to crises with liquidity and bailouts, hard assets tend to reprice. Gold usually gets the spotlight, but silver often follows with more volatility because its market is smaller and thinner. A relatively modest shift in investment demand can push prices dramatically higher. That is why people are even talking about silver reaching $100. Not because of hype alone, but because the math starts to change when confidence in financial plumbing weakens. To put this into perspective, think about the size of the silver market compared to global financial assets. The total value of above-ground investable silver is tiny compared to bond markets or equities. If even a small percentage of capital looking for safety decides to move into silver, the price does not gently rise. It gaps higher. This has happened before. In the late 1970s, a mix of inflation fears, currency weakness, and investor demand pushed silver from single digits to nearly $50 an ounce in a short period. Adjusted for inflation, that peak would be far higher today. Back then, the trigger was not a single bailout, but a broader loss of trust in monetary stability. Today, the ingredients look familiar, even if the packaging is different. Another factor quietly tightening the silver market is industry. Demand. Silver is essential for electronics, solar panels, electric vehicles, and medical applications. As governments push for energy transitions and technology expansion, silver consumption continues to rise. Unlike paper assets, you cannot print more silver. Mining supply grows slowly and is often a byproduct of other metals, which means it does not respond quickly to higher prices. When you combine rising industrial demand with renewed investment interest driven by financial instability, You create a pressure cooker. The lid stays on for a while, but once it starts to lift, the move can be violent. The idea of a Fed panic is not about officials running around in chaos. It is about urgency. It is about decisions made over weekends, emergency facilities announced after markets close, and language that shifts from tightening to flexibility almost overnight. A $50 billion intervention signals that something somewhere was not prepared for higher rates to last this long. It suggests that leverage built during the easy money era is now colliding with reality. And every time the Fed steps in, it reinforces a pattern markets have learned to recognize. Risk is socialized, losses are softened, the currency quietly bears the cost. Over time, that erodes purchasing power, even if it does not show up immediately in headline inflation numbers, for silver investors, or even those just curious. The question becomes simple but uncomfortable. If the system requires repeated bailouts to function, what does that say about the long-term value of paper money? And if confidence is the real foundation of modern finance, what happens when that confidence starts to fray at the edges? Silver does not need the system to collapse to rise. It only needs enough people to ask those questions at the same time. The move toward triple-digit prices would not be driven by a single announcement, but by a gradual shift in perception, where silver is no longer seen as just an industrial input or a speculative trade, but as a form of insurance against decisions made far above the average person's head. Because once that perception shifts, the market dynamics change in ways that most people only recognize after prices have already moved. And this is where the conversation around a $50 billion bailout becomes more than just a headline and starts acting like a signal flare for what may come next. When investors hear bailout, they instinctively think of taxpayer money. But in modern finance, bailouts are often executed through liquidity facilities, balance sheet expansions, and quiet guarantees that never require a direct vote. The Fed can create reserves with a keystroke, lend against collateral at favorable terms, and stabilize institutions, without ever calling it a rescue in plain language. Yet the effect is the same. More dollars enter the system, more risk is absorbed by the central bank, and the line between monetary discipline and emergency intervention becomes thinner. To grasp why this matters for silver, it helps to understand how confidence and liquidity interact. Financial markets are like a crowded theater. As long as everyone believes there is plenty of space and exits are clear, people remain seated. But the moment someone smells smoke, even faintly, behavior changes. People do not wait for confirmation of a fire. They move toward perceived safety. In financial terms, that safety often starts with cash, then quickly moves to assets that are not someone else's liability. Cash itself becomes suspect when bailouts and liquidity injections increase, because people realize that saving the system often means diluting the value of the currency. That realization does not happen overnight, but it compounds with every intervention. Historically, periods of aggressive monetary response have coincided with strong performance in precious metals. After the 2008 financial crisis, the Federal Reserve launched multiple rounds of quantitative easing, expanding its balance sheet from under $1 trillion to over $4 trillion in just a few years. During that same period, silver surged from around $9 an ounce in late 2008 to nearly $50 by 2011. That move was not linear. It was volatile, emotional, and often dismissed as speculative mania. But underneath the volatility was a simple driver. People were responding to unprecedented monetary expansion and questioning the long-term stability of the system. The balance sheet is already far larger, debt levels are higher, and the margin for error is thinner. A $50 billion bailout in this environment does not feel like a one-off. It feels like a reminder that the system still depends on emergency support. Another layer to this story is the bond market, which many consider the backbone of global finance. Rising interest rates have hammered bond prices, creating unrealized losses that dwarf those seen in previous cycles. Banks and institutions that bought long-dated bonds when yields were near historic lows are now sitting on assets worth far less than what they paid. As long as those bonds are held to maturity, the losses remain on paper. But liquidity events force sales. Bailouts are often designed to prevent forced selling, allowing institutions to borrow against depreciated assets rather than dump them at a loss. This stabilizes markets in the short term, but it also locks in a dependency on central bank support. Investors watching this unfold understand that stability is being engineered, not organically restored. That understanding feeds demand for assets outside the traditional financial system. Silver's role becomes even more interesting when you consider its dual nature. It is both a monetary metal and an industrial commodity. This means it benefits from financial stress and economic expansion at the same time, a rare combination. During periods of monetary easing, investment demand rises. During periods of infrastructure spending and technological growth, industrial demand rises. Right now, both forces are at play. Governments around the world are spending heavily on renewable energy, electrification, and digital infrastructure, all of which require silver. Solar panels alone consume a significant and growing share of annual silver production. Meanwhile, supply growth remains constrained by declining ore grades, rising mining costs, and the fact that most silver is produced as a byproduct of other metals like copper and lead. Even if silver prices rise, miners cannot quickly ramp up production. This creates a structural imbalance that does not show up in daily price charts, but becomes obvious over longer time frames. The idea of silver reaching $100 sounds extreme until you break down what that would actually require. It does not require hyperinflation or a total collapse of the dollar. It requires a repricing. If silver were to match its inflation-adjusted 1980 peak, prices would already be well above today's levels. If silver were to capture even a small fraction of the investment demand that flows into gold during periods of crisis, the price impact would be dramatic. Gold's market capitalization is many times larger than silver's. This means that when sentiment shifts, silver tends to overshoot. It moves faster, higher, and with more volatility. That volatility scares conservative investors, but it also creates the potential for outsized gains when conditions align. A bailout, especially one as large as $50 billion, acts like confirmation that the tightening cycle has limits. It tells markets that there is a threshold beyond which policymakers will not allow pain to continue. Once that threshold is identified, risk assets often rally, but so do inflation hedges. The narrative shifts from fighting inflation at all costs to balancing stability with price pressures. This balancing act is where currencies quietly lose ground, not through dramatic devaluation, but through persistent erosion of purchasing power. Silver does not need to outperform stocks every year to be valuable. Its role is to preserve value when confidence in policy falters. There is also a psychological component that cannot be ignored. Retail investors often arrive late to major moves, but institutional investors watch signals closely. When bailouts occur, risk models change, allocations are adjusted, hedging strategies evolve. Even a small reallocation toward precious metals from pensions, funds, or sovereign entities can have an outsized impact on silver. The metal does not trade in volumes comparable to equities or bonds. Liquidity is thinner. This means price discovery happens quickly when demand increases. By the time headlines start asking whether silver can hit $100, the move is usually well underway. The question many people struggle with is timing. Bailouts do not guarantee immediate price spikes. Markets can remain complacent longer than expected. Prices can consolidate, pull back, and frustrate impatient participants. But the structural forces do not disappear. Each intervention adds another layer to the argument for holding tangible assets. Each emergency facility reinforces the idea that the system is managed, not self-correcting. Over time, these realizations accumulate. They shape behavior slowly, then suddenly. Silver's history is filled with long periods of dormancy followed by explosive moves. Those moves rarely announce themselves politely. They begin quietly, while most people are still debating whether the risks are real. As the Fed navigates between inflation control and financial stability, the margin for error narrows. A $50 billion bailout is not just about saving one institution or market segment. It is about maintaining confidence in a system built on leverage and trust. When that trust wavers, even slightly, alternative stores of value gain appeal. Silver sits at the intersection of necessity and history, used in modern technology yet rooted in thousands of years of monetary tradition. That combination gives it staying power when narratives shift. The real question is not whether silver can reach $100 in theory, but under what conditions a critical mass of investors decides that holding it is no longer optional but prudent. Beck, Oz.